You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
This is the Option Industry Council's Wide World of Options. Before we start today's show, investors should know that options involve risk and are not suitable for all investors. You should not enter into an options transaction until you have read and understood the risk disclosure document, characteristics and risks of standardized options. This brochure is available by visiting optionseducation.org or by calling 1-888-OPTIONS. OIC makes no recommendation with respect to any financial firm. OIC does not make any warranty as to the accuracy, usefulness, timeliness, or the continued availability or existence of information created or maintained by others. Multiple leg strategies involve multiple commission charges. Opinions and strategies expressed by others are not necessarily those of OIC, nor does OIC endorse, warrant, or guarantee products, services, or information described or offered by such firms. Commissions, fees, margins, interest, and taxes have not been included in any of the examples used in this show. These costs impact the outcome of all stock and options transactions. Consult your tax advisor about any potential consequences. None of the information presented in this show should be construed as a recommendation to buy or sell security or to provide investment advice. Welcome to the Options Industry Council's Wide World of Options. OIC was created in 1992 to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. And the Wide World of Options radio show is one of the ways the message is spread. OIC also offers a variety of other resources to those interested in learning more about options, including webinars, podcasts, and live events. For more information, check out optionseducation.org. Now, here's your host, OIC's Director of Individual Investor Education, Joe Burgoyne.
Joining us on Profiles and Perspectives today is Investor Services' own Mark Benzaquen. Welcome, Mark.
Hi, Joe. How are you?
Doing great, thanks. Thanks for making time to join us. Before we get into your role at Investor Services, why don't you tell our listeners about your career path in this industry?
Well, Joe, I started in 1997 on the floor of the CBOE as a clerk for a market-making firm. From there, I went to the PCOST, the San Francisco Exchange, back in '99, back in the days of single-listed stocks. And when everything became multiply listed, I decided to head back to Chicago, and I was on the brokerage side with MF Global and EDF Man for a number of years. So I was in the business for about 20 years, primarily in the NASDAQ and Russell trading pits as the lead broker out there. So it's been a great career before transitioning over to the OCC, and I'm certainly love and ecstatic to be part of the team here.
Well, let me, before we get into the OCC part, let me go back to the floors, Mark. I mean, I was lucky enough to be, on the PHLX options floor for 23 years. So you were CBO for, about 7 years? But then, you mentioned the PCOST in '99. That was the tech bubble. That had to be insane. Tell me about that.
Yeah, it really was. It really was crazy out there. The business was, bursting through the doors. However, the big problem that we had out there is at the time when I went, everything was singly listed. If you wanted to buy, a certain stock or trade certain options, you had to go to a certain exchange. As you mentioned, with the .com boom, all of the different exchanges, Chicago, Philadelphia, New York, they wanted to get a piece of that too. So they started multiply listing all of the securities, and as the Pacific Exchange had a stranglehold on those options, now that everybody could trade them, the Pacific Exchange at that time kind of lost a lot of their strength. So it was interesting. When I was out there, after a few short months, a seat on the exchange, which you used to have to purchase in order to trade, a seat was at that time zero bid, meaning nobody was willing to buy a seat on that exchange. Nobody saw a future for it. And as the majority of the market makers, my friends and competition for employment, were originally from Chicago, I decided to beat them all back to the rush, back to the Midwest, and came back to Chicago in, I believe it was June of 2000, not too long after Y2K. And but at the time, man, let me tell you, it was crazy out there.
Well, good for you to have the foresight, to get out of Dodge and get back to the SIBO. That was really smart on your part. How about let's transition a little bit into, you mentioned OCC. How did you transition to investor services at OCC?
Well, in 2015, I was still on the floor at the SIBO and the NASDAQ and the Russell. Unfortunately, those products fell out of favor with my clients. They didn't really trade very much, and on the brokerage side, business was drying up, and I felt it was time for a change. I had been in the business 20 years at that time. All of the aggression and just adrenaline and all the stress from being in the trading pit that time, I decided that I wanted a little bit more of an easier life. So I started thinking about getting into education. I've always wanted to be a teacher. And while I was pursuing that, or while I was, looking at different avenues, I saw that there was a job opening at the OCC that I would be able to capitalize with my financial background in the markets, but also gave me a chance to use education as an outreach to individual investors, investment advisors, brokers, et cetera. And I thought, what a great way to combine and kill two birds with one stone, combine my interest in education and combine my background in the financial markets. So I joined OCC back in January of 2016. So it's been just a little over 2 years now.
Yeah, that's fabulous. Good match. Now, are you part of a team at Investor Services?
I am. There's myself and two other partners here at the Investor Services team, and basically it's a match made in heaven. We get along well. We love working together. We've got a great team here at the OIC as well as OCC, and we love what we do. My partner Bill Ryan calls us options geeks. And, he feels that we've got the greatest job in the world. We get to talk options all day long with individual investors and advisors, and it really couldn't be a better job, and I certainly couldn't be part of a better team.
So do you guys each have your own little geek band?
Well, we're working on that. We're putting in a requisition for some new wheels.
Okay. Well, let's, it's great that you enjoy it so much. You're very good at what you do. We're lucky to have you. How about if you tell our listeners, about a typical day on the firing line at Investor Services? What's it like?
Well, luckily, just like the trading floor, there really is no typical day. We take inquiries from, again, investors and advisors. They either call us on the phone or email or chat, and basically we talk options all day. A lot of the questions that we get are regarding, they run the gamut from contract adjustments. Somebody's got an option on a stock that just underwent a reverse split or a merger with another firm, and they're not sure how their option contract is going to be treated as a result of that corporate action. So we take a lot of calls and a lot of questions about that, as well as just people that want to use us as a sounding board. For example, an investor may think that stock XYZ is going to, be going up. They're bullish on it, and they want to know different ways that they could take advantage of that bullish outlook. And while we can't make recommendations or provide advice, what we do is we like to think of ourselves, as I mentioned, as a sounding board to where they can bounce their ideas off of us, and we can point out the benefits and the risks of those strategies that they have in mind. Another great thing that I've been working on lately that I'm really excited about is coming up with new content for our webinars, as well as a new a new project that we're working on called the Strategies Snapshot Series, where it's basically going to be an overview, like a mini webinar or a mini video that we're intent on putting up on our strategies page. That's just going to be a breakdown of each individual strategy, how it shapes out at expiration, and some of the benefits and the risks that go along with it. So, our typical day is busy, filled with coming up with new content and reaching out to individual investors and advisors all day long, and hopefully providing them with the education that they're looking for. And the best thing about it is everything's completely free of charge. People contact us with their ideas, and we respond to them, and it's a completely free of charge environment. It's unlike anything else out there.
Fantastic. And I love the fact, I think I share the same feelings about, there is no typical day, and we're lucky to have that situation. Tell me a little bit about, you were talking about those snippets. How long are they going to run, and where would investors be able to find them?
Well, right now it's still in the content development process, but the idea is that they're going to be mini, maybe 10-minute videos on our website. That the idea is that they'll go on our strategies page. We've got this wonderful page on our optionseducation.org website that lists close to 4 dozen different option strategies. And the idea is that not only will the investor or the advisor be able to read about these strategies in detail on the information that's already provided on the webpage, but then they'll have a video snippet as well to watch, and they can see how that option is going to behave in the market or potentially behave in the market at expiration. So it's our intent and it's our hope that we'll have it on the website shortly, but right now it's kind of in the beginning stages, but it's certainly something that we're all very excited about providing.
Very good. Okay, yeah. Let's see, one last question. You're on the firing lines there. One of the aspects is taking, calls and emails from investors. Is there a most common question that you hear from investors?
A lot of the comments that we get, a lot of the inquiries that we get is regarding a corporate action. When I've been in the business for, like I said, many, many years. However, my realm of expertise at the time was the indices. So I never encountered a stock split or a reverse stock split or a merger where the option contracts that I was trading on behalf of investors where those option contracts were being adjusted. So a lot of these corporate actions are very, very complex, whether it's a special dividend that's being announced or a distribution, a reverse split, a complex merger. A lot of these option contracts out there today go through these corporate actions, and it's very difficult, I think, for the average investor to figure out how their option contract is going to be treated. So a lot of the questions that we receive is regarding these contract adjustments. How's my option going to be treated, and what's the result going to be of that action? So we have on our website a informational memos section that our corporate actions team spells out how that contract is going to be adjusted as a result of the corporate action. So it's our job here at the OCC to help investors and advisors understand how their position is affected. That's probably one of the most questions that we get asked is, how is my contract going to be treated?
Well, as you said, you guys are in a unique spot where, the industry offers a resource like yourself, Bill and Ed, to investors to answer questions day in, day out. So it's great to get to know you on Profiles and Perspectives. Mark, any closing comments for our listeners?
Well, certainly, Joe, and thank you for having me. It's funny, I've been in the business for a long time, and boy, do I wish that I knew that the OIC existed when I was working on the trading floor. The amount of knowledge that I've gained about equity options since I've joined OCC far outweighs that I've gained in the 20 years of my trading experience and being on the floor. So a closing comment, something I would certainly urge listeners to do. Take advantage of our website, optionseducation.org. There's a wealth of material there ranging from the online courses to the strategies page, to a builder, options strategy builder that we now have, which is a wonderful tool that they can use to build a covered call, a covered combo, something of that nature. But also to take advantage of our investor resources team. They can reach us via email at options@theocc.com. We respond to your emails typically within a few short hours. And again, just to use us as a resource for education, for what-if scenarios, and to see how your contract is going to be adjusted, or just to bounce ideas off of us. We love talking to investors and advisors. That's the reason that we're here, and we absolutely love being a resource to the investing public.
Well, that's great, Mark. Again, listeners, you can reach Mark, Ed, and Bill at options@theocc.com. Mark, thanks so much for joining us today on Profiles and Perspectives.
My pleasure, Joe. Thanks for having me.
It's time to break down the latest option strategies. That means it's time for Strategy Spotlight.
Joining us today on Strategy Spotlight is Bill Ryan. Welcome, Bill.
Hi, Joe. How are you?
I'm good, thanks. And I should say welcome back. You are one of the great resources for OIC, and we always appreciate you offering your options knowledge to our listeners. So how about if we, start the conversation about this idea? Typically in Strategy Spotlight, we focus on one strategy, but I thought with the markets, running as they are, it might be a good opportunity for you to touch on a number of different strategies where options are involved and, may allow for portfolio protection. So how about if we just start simple and, puts? Why don't we just start with the whole idea of puts and how they can help investors protect a portfolio?
Yeah, sure. Puts a great place to start. Our listeners should think of puts as being an insurance policy. No different than having an insurance policy on your car, on your home. So that put ensures the value of your stock, and it simply works this way. If you're long the put, if you're a buyer of a put, you have the right to sell that stock at that strike price at any time until expiration, no matter how low that stock goes. Now, it seems kind of funny to be talking about stocks going down while the market's going up, and right now we're up another 160-something points today. It seems like we hit new records every day or every other day. So it's kind of odd to talk about the downside. But there are some stocks out there that people view as probably being a little pricey, something that, somebody might have had for a while, has watched it gone up, 6, 8, 10, if you're lucky, maybe 15 points, and maybe getting a little nervous about it. And if you're nervous in the short term, I think you look to buy the put to get that protection that you need. If you're really bearish on a stock, you think the stock is going down, I would simply say sell the stock. But the put acts as your insurance policy for a stock that you're long-term bullish and maybe short-term bearish, or maybe just a little concerned about something, a little pullback, and an opportunity to make a little bit of money on the pullback, and of course ensure that position for the length of time that you own the put.
Good point. With regards to if you're really bearish on an underlying, consider selling the underlying as opposed to buying protection. Obviously, the whole idea of tax implications comes into play there, but very, very good point. Taking that put idea almost a step further, what about this strategy of the married put? Would you kind of define that and speak to the pluses and minuses?
Yeah, sure. A married put is really a long put on a stock position, except that the two positions are put on the same day, basically at the same time. So you buy the stock and you buy the put at the same time. Now, it seems kind of odd to think that you're going to buy a stock because you want it to go up or appreciate and maybe collect a dividend, and you're buying a put in case something happens on the downside. But it's not uncommon for people to think that way if they think a stock is slightly overpriced. You could pick a stock. It's a stock you've been following for a while, XYZ, and it's been up, 3 points over the last 2 days, and you still like the stock, and you think there's more upside, but you're listening to the talking heads on television, and they're telling you to be a little bit nervous, but you don't want to miss this. So we're going to buy the stock and buy the put at the same time, and that means we have the stock, for the appreciation on the upside, but we have that protection for the downside. Now, it's not something that I would recommend you do with every position that you do, because that's going to simply get expensive. It's something that you use in certain spots, like a lot of option strategies. They work in certain situations, not in all situations, but in certain situations. So the only difference really between a married put and buying a put on your existing position is that with a married put, you do them both at the same time on the same day.
Okay. Well, I'm glad you brought up, the whole idea of, the expense associated with this insurance. How do investors, decide is there a certain recipe or approach to how much they should spend on insurance if they're looking for downside protection? Thoughts on that?
Yeah, that's a tough one. That's really an individual decision that investors make, and it'll depend, of course, on how much appreciation you have in the stock already. So if you're lucky enough to have owned the stock for a few years and it's up 15 points, you might be willing to spend a little bit more on the insurance. If you've only had it for a year or even less than a year, and it's up a couple of points, you might not want to spend all of your profit on your put, because puts can be expensive, and you could do a couple things to mitigate that cost. We can look at a put and look at an out-of-the-money put, which will be cheaper than in the money or an at-the-money, but you'll get less protection. So that's a little cheaper there. We can look at a closer in for a shorter-term event rather than a far-out event, and the closer input will be cheaper as well. But it's going to depend on the individual. How much money do you want to pay for insurance? How much do you want to protect? Do you want to protect the the whole downside? Do you want it at the money, like in case it goes down now? Do you want it in the money because you feel it's definitely going down? Or do you want the out of the money because you think it may go down? So you'd have to look at time and strike price, and that's going to determine the cost. And again, it's a very individual decision. How much money do you want to risk? So if you buy the out of the monies, you have a higher deductible, if you will, in your insurance policy than if you buy the in the monies or the at the monies.
That's a good way to look at it, your deductible. How about, since we're going to talk about a couple different strategies, we'll get to vertical spreads, but since we're talking about, puts as downside protection, we got a market that's, almost, crazy hot to the upside. How about if we speak to the collar? That could be, a way to maybe offset some of the costs of the put. Why don't you tell our listeners, what a collar is and how that may benefit them?
Sure. The collar is simply taking your position where you have a stock and you buy the put for protection, and then you sell a call against that same stock position. Now, selling that call brings in premium, and that premium offsets the cost of your put. And if you do it right, you can do that for even money or for a credit. Now, that sounds pretty good, on face value. Hey, I can sell a call, I can pay for my insurance policy, I have a free insurance policy or a cheap insurance policy. But there's another side to this, and that's the fact that short call limits the upside you have on the stock. Now, let's think through a situation, a little bit to explain it. If you have a stock that's up, you can buy the insurance policy, sell the call to pay for that put. But don't forget, you're buying a put for a reason, and the reason is you think the stock may go down. Now, if you think the stock may go down, it might be okay to sell that put because you're not expecting any upside. You're not expecting the stock to go through that strike price and be called away. So selling that call can offset the cost of the put. It limits your upside potential in the stock, but don't forget, we were worried about the upside potential in the stock to begin with. So it's usually a good idea, or it's a great idea, I should say, to do collars for even money, or even if you could do them for a credit. Now, of course, that does not include your commissions and fees, but the closer you get to even money or credit, the better off you're going to be.
Okay, so in terms of this protection idea, we've got the puts with stock, we've got married puts, which is making the trade simultaneously, and then we've got this collar that essentially is buying you downside protection, but the difference there is that you cap your upside depending on the strike that you sell. Is that kind of where we are with these three?
Absolutely, and the thing about the collar that a lot of people, tend to forget is the fact that they give up that upside when they sell the call, and that's very important that our listeners understand that they're giving up upside. And Joe, you've been doing this a long time, like I have, and we know that there's no such thing as a free lunch in the options world. You don't get anything without giving something up. We always have that unique trade-off, and the trade-off with the collar is that you give up upside in order to get that cheap protection.
But one thing about one of the wonderful aspects of the options market is how dynamic it is. So if your opinion changes, you can, potentially roll that call to a higher strike if you think there's going to be more upside. So it's not like you have to, once you initiate these positions, take them all the way to expiration if your opinion changes. True?
Absolutely, and that's another thing that a lot of people forget in the option business. They forget that they can adjust these positions as they go. There are a lot of individual investors who tend to believe that once I buy something or sell something, I have to hold it till expiration. That is absolutely not true. You can adjust your positions at any time during the life of that contract. And once you close a position, especially a short position during the day, you have eliminated the obligation associated with that position. So listeners should remember that just because they put a position on today doesn't mean they have to hold it till expiration, which could be 30 days out, 60 days out. They can get out of it any time they like.
All right, that's good. Well, we wanted to touch on, a variety of downside strategies. Let's jump to vertical spreads. There are 4 types of vertical spreads. How about if we touch on the 2 bearish ones? We've got the put vertical spread. You want to speak to that, the pluses and minuses as well?
Well, let's talk in general about spreads before we get into specifics, and make sure that our listeners understand that a spread involves buying one option and selling another one, and when you buy one and sell one, you create a right and an obligation. And in the case of a put spread, we buy a put, we have the right to sell a stock at a certain strike price, and when we sell a put, we have an obligation to buy a stock at a strike price. Now, we have to look at that relationship between the 2 strike prices and see what we're willing to pay for that spread in the case of a debit spread, and see what our possible profit range could be based on the spread. So any spread, the maximum value of a spread is the difference between the strike prices. So if we have a spread that has a difference of $5, we certainly can't pay $5 for that spread. We can't make any money. If we pay $4.50, we can only make $4. We can only make 50 cents on the spread. Probably not worth our while after commissions. So we have to understand a little bit of the math behind the spreads before we talk about the individual spreads. And it's important that.
Go ahead.
Well, it's just important that investors understand that relationship between the spread and the debit what they pay for that spread.
Okay, so let's run through an example. We got XYZ. It's trading $50. We want to put on a put vertical spread. Can you throw out an example or two?
All right, so we have stock trading at 50. Let's say we buy a put. We want to do these out of the monies or at the monies. Let's just say we buy the 50 strike put, and let's sell a 45 put. How would that work, Joe? You think that work well for our example?
Yeah, stock at 50, buy the 50-45 put spread. So what do we pay for something like that?
Well, that's a good question, and I think I'll let you, as the market maker, tell me what you think the 50 put would be worth with what do you think, 30 days? Yeah,
well, the key and you explained very well the whole idea of spreads. So implied volatility is not that big of a factor when you're buying one option, selling another, especially in the same month. So let's just say, as an example, we buy that vertical $5 spread for $2. The individual prices, who cares? We buy the 50, sell the 45. We buy it for $2. What's our maximum profit? What's our maximum loss?
All right, so we pay $2 for the spread, and as you said, the individual prices don't matter. It's the price we pay for the spread that makes a difference. So the difference between the two strike prices is $5. We paid $2. That means we can make $3. So $3 is our maximum profit. $2 that we paid for that spread is our maximum debit. Can't lose any more than that.
Okay. Other potential examples, you could buy the stock again is 50. You could buy the 55 put, $5 in the money. You could buy and sell the 45 put. Maybe that would trade for $5. So in that example, if you pay $5, obviously the $10 difference in strikes, I guess you could make $5 if the stock was under 45 at expiration. Is that right?
Right, and so the difference between the strikes is the maximum value of the spread is 10 minus what we pay for is 5 means we can make 5. But there's also an opportunity in the middle there where some things can happen. Let's look at that 55-45 put spread, and let's say the stock closed at 50. Well, if the stock closes at 50, our 55 put is in the money by $5, our 45 is out. So we'd make $5 in the 55 put. We wouldn't make any money in the 45. We paid $5 for debit for the whole entire spread. It would be even. So we have a break even there of 45.
Okay, and then
break even at 50 there.
A break even at 50, and then
right.
You could do the same thing. So I guess one of the real keys is the strike selection, because you could buy the out of the money as you described earlier, the 45 put, sell the 40 put, and then you can look at these spreads from a delta perspective too. I guess just to throw one more wrinkle in. Yes.
Yeah, we can look at them from the delta perspective. We can also look at them from a point of view of what our personal feeling is, and again, on our protection and look at the protection side of this again. The 55 put being in the money is going to be at least $5 if the stock is at 50. Maybe it's going to trade for more than that. Maybe it trades for 6, and we think that 6 is too expensive. We sell the 45 put to bring in a little bit of money to offset the call of that long put. Now, when you look at that, we're thinking the stock is going to come down a little bit, but obviously we don't think it's going to come down past 50, because if it comes down past 50, we have to buy more stock. So we want the stock to trade in that range. We want the stock to trade in the range. Now, we can look at the deltas and say, the delta of the 55 versus the delta of the 45, and then we have an offset on the deltas there. So you can look at it from a delta point of view as well.
So all the examples we've talked about so far, Bill, are in the put vertical spreads, are the debit spreads. Let's flip it over and talk about, vertical call spreads, which are on the credit side. Let's go through a couple examples.
Yeah, sure, Joe. And like you said, we're just kind of flipping this thing around. With the call spread, we're going to buy the higher strike price. We're going to sell the lower strike price, and that's going to give us a credit. Now, the same theory applies, but the difference between the strike prices is the maximum value of the spread at expiration, and we have a credit. Now, in the case of a credit spread, the most we can make with a credit spread is the credit that we bring in when we sell that spread. The most we can lose is the difference between the strike prices minus that credit. So, for example, if we buy a strike price with a price of 25, a call 25, and we sell the lower at 15, we end up with a 10-point difference between the spreads, and between the strikes. And if we did that for a $5 credit, the most we can make is the $5 credit. The most we can lose is $5, which is the difference between the two strike prices less the premium that we brought in. And you can look at this, as we're expecting the stock to drop, so we want the stock to come down. We want that higher call strike price to decrease in value. We want the lower call price to decrease in value, and that's how we can make some money. But again, we can't make any more than the difference between the strike prices. We can't make any more than the credit we brought in, and we can't lose any more than the difference between the strike prices less that credit that we brought in.
Okay. Is there any preference for investors to do, the vertical spreads for a debit or the vertical spreads for a credit, or is it just personal preference?
Well, that's interesting. When you compare these, and if you look at the same strike prices in the calls and puts, you'll find out that the risk and reward is almost identical between the credit and the debit spread if you use the same strike prices. Now, the difference is going to occur at expiration, because at expiration, the credit spread you want to expire worthless, so you keep all that all of that credit. But the debit spread you want to expire in the money, so you can get, you can go through the exercise and assignment process and get the difference between the strike prices less what you paid for it. So it's going to be dependent at expiration what's really going to happen. It's pretty much a personal preference. A lot of people like to put money in their pocket. They think that's great. I'm going to put money in my pocket rather than pay for it. But what they fail to realize is with that credit spread, the margin is going to be the difference between the strike prices less the premium. So you either have to put money in the account anyway, or you have to use up available funds to do the credit spread. So it depends on the personal preference. Some people, like I said, putting money in their pocket. Others think that they're better off if they just go out and buy this and let it run from there.
One last question for you, Bill, and I'm not sure that this is an easy one. How do investors go about picking strikes, for these vertical spreads?
So picking strikes is difficult. Most of the spreads that I've seen and the customers I talk to like to start with the at the money and then work their way either up or down from there depending on what you're doing. Once you get to the in the monies, they get more expensive, and the at the monies is where most of the volume usually takes place in the options world. So there should be plenty of liquidity at that point, and then you move up or down. And moving up or down is something that you have to pay very close attention to, because the wider the spread gets, the less premium you're likely to bring in, and there's more opportunity in the middle to make a little bit, but not the maximum value of the spread.
All right, Bill. Well, we covered a lot. Long puts, married puts, collars, vertical put spreads, vertical call spreads. I want to thank you for your insights, and it's always great to talk to you, and especially on Strategy Spotlight. Thanks so much.
Thank you. Always my pleasure, Joe. We'll talk to you soon.
Thanks, Bill.
Next, let's upgrade your options toolbox with cutting-edge trading platforms, devices, and information. Let's talk about tools, resources, and good reads.
Welcome to today's Tools, Resources, and Good Reads. Our mission at the Options Industry Council is to inform investors on the benefits and risks of exchange-listed options. I'd like to highlight a couple OIC tools and resources in today's segment. The OIC has really good tools and resources, so let's go through a few. First, on the tools side, go to optionseducation.org, and under the Tools and Resources bar, check out the Options Strategy Builders. You can learn about 4 strategies in this one tool: the cash-secured put, the collar, the covered call, and the covered combo. That's the Option Strategy Builder under Tools and Resources and the tab that 321. That's the Option Strategy Builder under the Tools and Resources heading at optionseducation.org. Our resource today can also be found at optionseducation.org under the Tools and Resources tab as well. Check out the Frequently Asked Questions section. You'll find 13 interesting option topics that are clearly explained, including weekly options, expiration, and much, much more. And our good read today, surprise, is found at optionseducation.org under the News and Resource tab. Go to the white paper section and see over a dozen industry white papers posted there. Lots to read, lots to learn. Thanks for listening. That's today's Tools, Resources, and Good Reads.
Ready for a little nostalgia? It's time to take a look back.
Watching the market achieve all-time highs time after time in recent months gives us an opportunity to review these new milestones in today's Looking Back. Let's look at market milestones over the past 25 years or so. So lots of numbers coming. And how about if we start with the S&P 500? This index, which today trades over 2,800, traded at 500 in early 1995 and incredibly tripled to over 1,500 just 5 years later. It was 8 years after that, in 2007, after a protracted sell-off and sideways market that the S&P finally traded at 1,500 again. After the financial crisis, it took my 5 more years to get back to 1,500 in the S&P, and that was in 2013. But then 2000 came quickly. Less than 2 years later, at the end of 2014, we surpassed 2,500 in 2017, and as mentioned, we're over 2,800 today. So that's a quick look back at the S&P 500 and some of its milestones over the last 25 years. Let's look at the Dow 30, now trading over 26,000. It traded over 5,000 for the first time in 1996. 10,000 just 5 years later in 1999. Remember the tech boom? 15,000 didn't come for 14 more years in 2013. But then 20,000 came rather quickly in early 2017, and remarkably, 25,000 has been surpassed already in early 2018. I think the Dow is making up for lost time. And talking about a wild ride, let's give the NASDAQ Composite a quick look, now trading close to 7,500. 1995, the NASDAQ traded at 1,000 for the first time. The tech-heavy NASDAQ traded over 5,000. Yes, 5,000 just 5 years later in the year 2000. It took us 15 full years to get the NASDAQ back to 5,000 in 2015. 6,000 and 7,000 were both surpassed in 2017, and we're currently close to 7,500 as we, record this session. Again, NASDAQ may be making up for lost time. I know that was a lot of numbers. Hope it made sense. Markets, please continue to bring us new milestones. That's today's Looking Back.
We love connecting with our listeners. With that in mind, let's take a moment to answer a few questions on OIC's Wide World of Options Q&A segment.
We appreciate the steady flow of questions that come in from our listeners. Today, we'll answer a few of them. Crosby Ventures asks the following question: what are the 3 top ideas for folks just learning to trade options? Well, here's my take. 1, and this is not meant to be self-serving, it's just the truth, get familiar with the OIC website at optionseducation.org. There's a lot there. Start on the first drop-down bar, Getting Started. That should make some sense. Don't forget to register for MyPath, which will download tutorials for you based on results of the 20-question assessment test that you'll take. There are lessons at the beginner, intermediate, and advanced lesson levels there. That's number 1. 2, if you like to read, consider Brian Overby's Options Playbook. It, too, is a good place to start. And 3, investigate the education tabs on your brokerage firm websites, as well as the websites of the various option exchanges. You might be surprised how much you'll find. A closing comment: you may be amazed how much and how quickly you'll learn after actually opening or initiating an options trade. So don't be afraid to do that. Good question, Crosby. Thank you. Next, Kraken 1975 asks, which of the Greeks should I use the most and why? This is an easy one for me, but not everyone may agree. Vega, hands down. Why Vega? Because Vega, or implied volatility as it's also known, these levels in an option will go a very long way to defining the premium level of the option price. Options have potentially 2 parts to their price: the in-the-money amount, or intrinsic value, if the option is in fact in the money. But on top of that is option premium. And again, Vega is a huge factor in determining the option premium portion of the option price. Delta would be my second choice. Like many option concepts, Greeks do not have to be complicated. Greeks drive option prices. If you think options are for you, please make a point to know a little something about the Greeks, or as I refer to them, the option pricing factors. And of course, start with Vega. Thanks, Kraken. And our last question today comes from Charlie C. He asks, what's the weirdest thing you've ever seen in the options market? Well, Charlie, the craziest experience I've ever had in the options market dates really way back to June expiration, 1982. Gulf Oil announced a $54 takeover of City Service, the oil company. I was one of the specialists in City Service. That happened on Wednesday afternoon, right after the market closed. Remember, this was June expiration week. The stock didn't open or trade on Thursday, and all day Friday, no trading until the closing bell at 4 p.m. The stock traded at $54. And then we were able to do an opening and closing rotation in the options, as it used to be called back then. We didn't finish trading those options and rotations until 7:30 that night. It was really crazy and weird, Charlie. Thanks for asking.
You've been listening to the Options Industry Council's Wide World of Options. If you have questions about anything you've heard on today's show, email Joe Burgoyne at options@theocc.com or visit optionseducation.org and chat with Investor Services. Interested in connecting with OIC on social media? Like the OIC page on Facebook. Follow them on Twitter at options_edu and Instagram at optionseducation, and follow their page on LinkedIn. Thanks for listening, and be sure to tune in to the next episode of Wide World of Options.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/The Options Insider, or via questions@theoptionsinsider.com.